Hey guys, welcome. Today, we're going to talk about what I like to call the Great Churchill Capital Corp Lucid Merger Saga. Specifically, we're going to look at why a stock that had hovered around $10 since the company went public in September suddenly tripled in price in less than a month, and why it might go up or crash soon. Keep watching till the end since we're going to go over every aspect of this ever-changing story. Smash that like button, subscribe, and ring that bell to get some notifications. To understand what happened between Churchill Capital Corp. 4, or as it's better known by its stock ticker CCIV, and the electric car company Lucid Motors, there are a few concepts we need to go over first. The first concept you have to understand is the initial public offering, or IPO. An IPO is what makes a private company public. For example, let's say Jim wants to sell hot dogs. He opens a store called Jim's Hot Dogs. This is a private company. The only owner is Jim. He sells hot dogs locally to his friends and family. Life is good. Well, one day, Jim buys a store across town to expand his market, sell his hot dogs to more people, and get more money in the process. And then another. Then another. Pretty soon, Jim realizes he needs a way to make a lot of money fast if he wants to be able to keep expanding. Jim does an IPO. He gives up a certain amount of ownership in his company and sells the rest of the ownership in pieces to investors. These are stocks. These investors will pay him money for those shares of his company. Jim then uses that money to expand, buy better hot dog buns, whatever. Shares of Jim's hot dogs are now bought and sold on a stock exchange, and there are a whole host of new responsibilities that Jim faces as the owner of a brand new publicly traded company. The next concept you have to understand is a special purpose acquisition company, or SPAC for short. A SPAC is a company whose sole purpose is to buy or merge with private companies, like Jim's Hot Dogs before the IPO. Remember CCIV? Well, CCIV is a SPAC. Because SPACs don't actually have their own business plans and usually don't even have a target in mind when they're formed, they just have in mind to merge or buy companies. But people invest in them anyway. They're often called blank check companies. So why would a company like Jim's Hot Dogs choose to be bought out by a SPAC rather than just do its own IPO? Well, some companies choose to go public through SPACs because there are fewer legal loopholes than going public through an IPO. Others do it because there's less price uncertainty when you're dealing with a SPAC. The catch is that SPACs only have 24 months to find a target and close the deal. If they don't make it in time, then they're automatically dissolved and their investors are given pieces of whatever's left over in proportion to the amount of shares they own. Either way, CCIV was tied for the largest SPAC created in 2018, IPOing with a market cap of $690 million when it went public in 2020. And in January of 2021, investors started talking, and they were convinced that it had its eyes set on a little car company called Lucid Motors. Lucid Motors started in 2007 under the name Ativa and was originally focused on manufacturing batteries for electric vehicles. Over the next 10 years, Ativa attracted over 500 employees, including some who had previously worked at other car companies like Mazda and even Tesla. In 2016, Ativa reorganized itself as Lucid and decided to tackle building its own high-performance electric cars, rather than just the batteries for other cars. In 2016, Lucid announced plans for a $700 million factory in Arizona, and in 2018, Lucid announced they were in talks with the Public Investment Fund of Saudi Arabia for a $1 billion valuation. It's no wonder then that Lucid Motors rapidly became the apple of CCIV's eye. You see, Andrew Liveris, the chairman of Lucid Motors, is actually a partner at Churchill Capital, the owner of CCIV. And Michael Klein, the CEO of CCIV, is a longtime advisor to Andrew Liveris. When Andrew Liveris ran the Dow Chemical Company as its CEO, it was Klein that he called on to run a joint venture between Dow and Saudi Aramco, a giant Saudi oil company. Due to the close relationship between the leaders of both companies and the fact that Liveris found himself in the unusual position of being able to make money on both sides of any potential CCIV-Lucid merger, investors began to suspect that it was only a matter of time before it became official. This would be great news for Lucid, but it would be really great news for CCIV since, remember, SPACs only get a 2-year time frame to seal the deal. That's why in January of 2021, after hovering around $10 since it went public, CCIV's stock basically went up over 200% in just a couple of weeks. Anytime two companies announce a merger, even if it's a normal merger, for example a merger between two real companies and not a SPAC and a company, the stock price of whatever publicly traded companies exist in the deal react. If the stock price rises, that's called the stock premium, and it's a calculation of whatever investors think the stock price can be once the companies have merged. This is weighted by the investors' calculated probability that the merger will actually happen. So when CCIV's price rose from $10 to $30, that was basically a combination of what investors thought the company would be at after it bought Lucid Motors, multiplied by the probability a deal would actually happen. As a deal between two companies becomes less likely, the stock price increase will usually react as well. And that's exactly what happened after the Financial Times reported that Lucid was going to build a new car factory in Saudi Arabia. Many investors saw this as a bad sign for the merger. Why, after all, would Lucid take on such a huge, risky new investment if it already had a huge, riskier merger on the horizon? When the Financial Times article came out, CCIV's stock price dropped from $29 a share to $21 a share. Finally, on Wednesday, February 3rd, Dow Jones reported that talks between CCIV and Lucid Motors were continuing, though a deal isn't imminent, according to People. As you might imagine now, this caused CCIV's shares to fall over 12%. Then, because the story hasn't been crazy enough already apparently, on Thursday, CCIV stock shot back up and broke over $30. So many people have become intrigued by this bizarre series of stock events that over 80 million people bought and sold stocks on Thursday, February 4th. I can't seem to find any news that came out on Thursday regarding the merger, so it seems like that peak is just reflective of exactly what I was saying, which is that as a merger becomes more likely in investors' eyes, the publicly traded participant stocks will rise, and as it becomes less likely, they'll generally fall. On Thursday, since it had already been a day since the Dow Jones article came out, investors saw the merger as more likely than they did on Wednesday. So where does this leave the future of Lucid and CCIV? Well, it's still really up in the air. If a deal is actually confirmed between CCIV and Lucid, I would expect the stock price of CCIV to rise. If, however, there is an announcement that no deal will happen between CCIV and Lucid, I would expect CCIV stock to sink back down to $10, or maybe even lower. CCIV still has time to find a target for a merger or acquisition. Even though it was founded in 2018, it only went public in 2020, and that's when the 2-year countdown starts. However, once deals go south, it's not hard to see why investors might get antsy, let alone leadership of any future targets CCIV might come across. So guys, that's the crazy ongoing story of how a blank check company tripled in value in less than a month. If you like what you saw, remember to smash that like button, and subscribe and turn on notifications so you don't miss out on more videos. And I'll see you in the next video. Take care.